So guys, today we are going to start with investment management. This investment management could also be read under two subheads, that is investment analysis or portfolio management, or security analysis or portfolio management. It is one and the same. This is divided into 5 chapters. First 3 chapters are dealt with security, means the intrinsic or true value of the security founding will come in security analysis. True value or intrinsic value. The risk involved in that investment, that will be dealt in this first 3 units, and the last 2 units will be with portfolio management. The combination or diversification of your securities in order to minimize the risk and maximize the return, and the revision and construction of your portfolio we are going to learn in portfolio management. So this is briefly which we are going to see in this investment management subject in the coming sessions. So first let us start off with investment. What is investment? So commitment of funds today in expectation of returns tomorrow. Today we are sacrificing some fund in order to get more funds tomorrow is considered as investment. So before doing the investment, we have, or the investors will have certain objectives. So what are the objectives of investment? The objectives of investments are like this. First one is risk. The investor will assess what is the risk that is involved in this investment, whether it is minimum risk or maximum risk or moderate risk. So based upon the risk factors, his expectation for return will be there. So that is the reason he will first think of what is the risk involved in the certain investment. If at all I am going to invest in banks or FD, what is the minimum risk that I have to take? If at all I am going through a stock market investment or equities, what is the risk involved in that? That's how I am going to assess the risk. So whenever once the risk is assessed, based upon the risk, I'll expect, or the investor will started expecting his return. So the return is basically 2 types. One is historical return and expected return. So how much that particular, suppose if at all the investor has selected through going with equity investment, so he has to study about its past history. What is the return that that particular security has been provided till now? So based upon the historical return, he could expect his future return. So this is already realized return. This is the expectation of the investor, that is returns for tomorrow, and this is already committed. How much I have to commit? Historical will tell me how much I have to commit today, and based upon the risk I am going to take and what I am going to receive in the coming future will be explained by the return. And then he need to ensure the safety of funds. How much safe my investment is. So that is the another objective the investor has to assess. And liquidity. Whether I could convert this investment into current money or not. If at all I have some emergency, whether I could convert that investment into money or not to fund that emergency requirement. So that is one of the objective the person has to see, or the investor has to assess. And next one is hedge against inflation. So in an economy, inflation is a prevailing element. So how the inflation is going to affect our investment? So how it is going to affect our investment means, so investment, usually you will have some income. In that income, what we will do? We will do lots of activities, like we'll do purchases. We'll do so many things, like we'll purchase our daily requirements, we'll purchase gifts, we'll purchase groceries, we'll purchase commodities, like that. So many purchases we will do, and after that, if at all we are left with any extra amount that will be considered as saving. So if inflation increases in any economy, what will happen means, for these purchases, the investor or the individual has to put more amount. So that more amount he has to take it from his savings. So ultimately what will happen, with increased inflation, the savings of an individual will decrease and he will left with less amount of investment. So that is the reason that fellow has to hedge against inflation. Hedging is nothing but balancing his position against inflationary conditions is hedged against inflation. So these are the basic objectives the investor has to keep in mind whenever he will be doing his investment.